Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, January 14th, 2025. It's 1:56 p.m. Eastern Time as I'm starting the video, so we have a couple hours left in the trading day. Just wanted to fire one off. I like to do these videos. I can cover a lot more levels and potential developments to watch than just those screenshot charts with a couple lines, a couple sentences of what to watch for. So just to reiterate, this is the SPY, the S&P 500 60-minute chart. We still very much have those 60-minute divergent lows in place. As I've said many times in the past, these are really just the kind of the gold standard in my book for swing trading, looking for divergent highs, divergent lows. There was a divergent low there. You got a rally, divergent high there, correction, divergent low now. I'll just borrow these letters here, duplicate that. Again, this has been covered in recent videos. Now, that comes on the heels of a much a bigger breakdown of a pretty significant uptrend line. So, like I've said, cross currents, but not just cross currents. Okay, I try to always compartmentalize. At any point in time, I can be bullish longer term on something and bearish shorter term, or vice versa. So we have some pretty good sell signals on the long term charts. Again, I'm just reiterating everything I've covered in recent weeks. Big bearish engulfing candles on QQQ, stocks like Nvidia, some nice trend line breaks. And then there's some other things that haven't yet broken support. I'm going to go over that in this video. So the things to watch if trading the market, because that seems to be where the most comments come from. I think there's better opportunities elsewhere. Right now, like I said, I'm pushing the grains pretty hard, and they broke out. Ag input stocks, I see much better, especially for an investor or swing or trend trader, much better RR, and particularly for those that only like long side trades. They have infinitely better risk reward profile, in my opinion, and outlook than the stock market does. If you're looking out where to, put some money for 6 months and, over the next year or so. But that being said, treasuries right now, I think, they can't get going, but the RR, I really like them here. I liked them a couple weeks ago. I like them even better now, even though they've just not taken off yet. I'll get to those in a second. So, but let's just knock the markets off real quick. So that's it. It's a divergent low. Divergence is not a buy signal, like I always say, which you can do in an uptrend, which we're in a larger uptrend. You can buy pullbacks to support. This was a massive gap. All eyes can see that gap. So far as I've covered recently, it's a gap backfill on SPY. So you buy support with a stop somewhat below. There is a possibility this market may want to just continue to shake out. I know a lot of, active traders might be getting frustrated. I'm sorry, typical swing traders. Active traders should embrace this kind of volatility, these rips and dips. But longer term swing and trend traders, even investors, you can see the market's gone nowhere. The S&P 500 is trading where it was back in October. So you went down a little, then you went up a little bit, and you're back to where we were. But active traders can flourish in these kind of markets with increasing volatility. Okay, so that's it. If we do push in and make a marginal new low, again, it must be marginal, meaning not too much below the recent lows. Anytime soon, you'll still have that divergence. We could extend the divergence lines. After that, it's gone, and especially in light of the recent big sell signals, it makes it very hard to make the case to be long, as even a short-term swing position. I'm talking a short-term swing trade lasting days, maybe a week or so. That's all I'm looking at right now, just trying to game another hurrah off this divergent low on the active trading account. So that's SPY. Just to recap it on the daily chart. Let's see. I think this is a cleaner board here. Somewhere I have a clean board. Right here, we'll just use this one here. You have this downtrend line right here. It sort of gives us, if you look at it this way, as I've highlighted, almost like a megaphone pattern. But either way, that's we've been flirting with that level. There's that big gap I just highlighted here on SPY. Let's move on to QQQ. So QQQ, I have different boards on QQQ. This is my daily chart. The divergent low, that should read on the 60-minute chart. Let me drop down to a 60 real quick for you. There's the divergent low on the 60-minute chart. This is the one I gave you the other day. I initially had a stop there, and then Monday morning, I made sure well in advance of the market opening, before we exceeded that posted a scenario. I expected a flush out move, bear trap scenario, false breakdown. So I was going to suspend my stops, give it a little more room, and that's why I removed that stop line. And that's so far what happened. Again, I covered that before. Now, we're not out of the woods yet. You can see there's some support down here, a little lower. Again, it's possible to we make another run at that level and could still keep these divergences intact. We'll see. As of now, like I said, there's just, all these little rallies are getting sold into in the last couple days, and we are, remember, the bigger picture, or at least intermediate term now, short to intermediate term, is we're in a downtrend right there. And remember, that downtrend comes after this right here. When you go out to a weekly chart, as I covered, was a bearish engulfing candle back a few weeks ago. So, and then a trend line break. So there's a lot of reasons to be short. Another one is the PPO. We have a bearish crossover. I think I've covered this. If I haven't, the PPO histogram crossed over on the weekly time frame right here, and that's a pretty good trend indicator when you get a bearish crossover. There was a couple weeks more of selling there, not much, and then we went to new highs, but a lot of the big turns, including the top back here in 2021, was triggered by a trend change there with the PPO. So we'll see. It's early on, and again, right now I think it's just, again, it's the active trader in me. If I can see the odds for even a 3% bounce, why not take it? Why give that back in shorts? And again, I wear two hats, talking active trading account. That's when I tend to be more flexible and nimble. And so as of now, sitting tight on those bounce longs. Let's look at IWM real quick and then look at the Mag 8. And then I'm going to move on to other things. I'm going to cover Bitcoin, treasuries, nat gas, crude oil, and the grains and ag input stocks. Kind of the core stuff I've been highlighting recently, as far as, remember, the kind of overall theme here, and I always try to do this, is diversification, also diversification via asset allocation, meaning at any one time, don't have all your money in stocks, don't have them all in gold or crypto, don't have it all into commodities, spread it out. Diversity is a trader or an investor's best friend, and so is asset allocation. So IWM, remember we had that primary trend line break right there, pretty powerful sell signal, but as I said before it even happened, if we broke down, you had both price support and the 200 days. Some people see trend lines, some see moving averages. I like to trade both because of that reason, and like I said, you can't get too bearish because in a bull market, you buy pullbacks to the 200. Now, if those 200s go, and sooner or later they will, then we'll be short, and we'll be looking to short rallies back into the 200s if they're back tested from below. But as of now, that breakdown so far, and I have to imagine quite a few shorted the breakdown there, swing and trend traders, and if they position for it, well, they're back to where they shorted. If we go much higher, like I said, on QQQ, SPY, and everything else, I can see back tests of these trend lines, and so that may take into maybe possibly next week. And remember, trend lines are dynamic. They come in at higher and higher prices every day. So, if 2-3 weeks from now we're still back testing from below, it's going to just not be fun if you're a short seller. You're going to be, going back testing at higher and higher prices. All right, speaking of back testing, and you might want to check comment sections. There's quite a few replies that I've made today, including in this thread. And usually if I see something worth mentioning, I'll post it under the comment section. So where was it? Right here. Somebody asked, there's updates if you want, Etsy, Dollar General, as well as Dollar Tree. I threw that out there along with them. You can read that. Where was it? Somewhere in here. Yes. Are you still along the cues in the active trading? Yeah, this is what happened today. This is that 15-minute chart I told you. When I go into active trading mode, I'll come down, step down, often focus on the 5 to 15-minute charts. And as I've been talking about, these are those rips and dips. And this is what I've been talking about heading into the end of the year, telling you to put on my active trader hat. And this is, again, frustrating for a swing trader. Now, if you took those bearish engulfing candles and you're holding short, you're still profitable. You're okay there. Kind of sucks to see you give back almost all or sometimes all the gains and go down. And again, if I can see the possibility or probability of this, in which is, comes with an elevated VIX, elevated volatility, uncertainty on the markets right now. These moves are 2-3% in each direction. So, you can easily make, 10-15% just swing in the rips and dips, even if you catch a good part of it, just the middle of it. But either way, it's what's going on in the market now. Like it or don't like it, just understand what market you're trading, and if it's not in your skill sets or your wheelhouse, then sit back and wait for your pitch. Right there is a breakout. This is what I posted earlier today in the thread. So basically, that sell off this morning into today's lows was simply a back test of that trend line that we have had there on the 15-minute chart of QQQ. So what we need to do now is pop these previous highs in QQQ and SPY, and that should open the door. And again, looking if these recent lows can hold, we can start popping some highs. You'll see some short covering most likely. And of course, we need to hold support on some of the key stocks. I'm going to get into those in 1 second. So let's roll into that now. I already covered the big three. Futures traders, I gave you those charts this morning, but if you want them, here they are. Let's NQ. There's the NQ. And so, you don't see that 15-minute chart here, but that was the of QQQ, the downtrend line, but that was the back test. So again, at this point, we need to pop those highs. We did fall back below that level, but we're still above the recent lows, and that was good support. So, it's still a near-term target right here for the NQs. And then look, if this forms in, which it's sort of takes the shape of a falling wedge, at the very least, it's a divergent low. If we pop that, you've got 1, 2. You take out that second previous high, you're probably going to pop and go to new highs in the Nasdaq. And remember, if we backtest, I've been still open to a backtest of the trend line. You got to realize it's quite a ways up there now, and it most likely, based on if and when we backtest it, if we were to. I prefer not to see this. I'm not favoring it right now, but I'm being flexible. I'm thinking ahead right now. How should I be positioned today, this afternoon, tomorrow? We'll see. I'll play this by ear. I may stay long throughout here. We'll see what happens. And what determines that? It's not just QQQ, but a combination of QQQ and the top 10. Let's look at those real quick. Apple, primary trend line break is covered here. That's a pretty good sell signal. However, Apple hit some pretty good support here. There's a previous highs right there. Apple may want to backtest, may not. PPO is still in bullish territory. You can see my delineation line that delineates bull and bear trends is right around the zero line there, close enough. And so basically when the PPO is above the zero line, the trend is bullish. And what you do is you buy pullbacks when the PPO backtests the zero line. That's bullish, and that's where you buy the corrections right there. If you bought it there, look what happened. Apple did this. Then you had another back test right here on this pullback, and Apple did that. Then you had another back test. So right now, that's all I can tell you. This delineates bull and bear trends. When the PPO is below the zero line, as it was throughout here, it's a bear trend. You want to be short. Below, bearish trend. The rest of the time, it's been above, and Apple was in an uptrend, right? Simple stuff. So you can't get too crazy bearish until these things start happening. And again, it's not any one of them, it's collectively. It's Apple, Nvidia is below the primary purple uptrend line. Again, one of my favorite shorts, bearish engulfing candle, breakdown, back test of the purple primary trend line, comes all the way off the October 2022 lows. However, you've got some pretty decent support right here. It's pretty much the previous highs, breakout, back test, back test, back test. It needs to clearly take out those recent lows. So, longer term, it still looks good, but you can also see the trend indicator down here. I have my line on the PPO about negative 1.37 tends to be where it delineates bullish and bearish larger trends right there. Microsoft below the primary trend line right there. So that one, but it's also in close proximity right on the 200-day moving averages. So again, you can't get too bearish until the 200s clearly go. They took it out there, but I acknowledged that at the time and said we're going long. We're covering all shorts there because most other stocks and or the indexes at this very same time were either hitting their 200-day moving averages or primary key uptrend lines like NVIDIA and some other things. But then you can see this is humans and computers both buy big tech stocks and the indexes on pullbacks to the 200 days in a bull trend. When the 200s go, that's going to increase the odds that my longer term downside swing and trend targets on the indexes are going to be hit. And it's not just any one stock. You got to take them collectively. The majority have broken support. The majority are below their 200-day moving averages. Pretty safe to move yourself towards that bear bias, short bias, where you short the rips and cover the dips instead of buy the dips and sell the rips. All right, Alphabet. Let me turn the lines back on. Alphabet is a minor trend line, but it's worth noting. Just broke down recently, so you can see that there's, again, it's a mixed bag. I'm getting sell signals one after another, but I also have other things pulling back to supports like the 200 days, so I'm not in love with the longs that I have right now. Again, in the active trading account, and I feel pretty comfortable, not fully confident, but pretty comfortable that the long-term shorts, that have in other accounts will play out. And I'm still waiting to take those to more aggressive position. I don't think right now warrants being too aggressive for the reasons I'm stating. If I can sit here and tell you half these stocks like Amazon, look at this beautiful uptrend line. This is, of course, a daily chart again. Nice, clean, well-defined uptrend line off the August lows. Look at all those reactions. And price support. This was an all-time high right here. You had a breakout, successful backtest, backtest, backtest. See, it's been backtesting. So Amazon needs to boom, 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 boom. That'll be another check mark for the bearish case if and when that happens. Until then, all I can say is I often do, support is support until unless broken. So that's that. Meta crowd testing the trend line today. This is I know it's a busy board. I'm going to replicate this trend line for you clean. I'll show you what I'm talking about. This one right here, come off this low from October of 2023. Draw a trend line, beautiful, nice and clean. Doesn't get much better than that. 1, 2, a couple reactions there, but in close proximity. 3, 4, and now 5. Now, it's a trend line. Yeah, you can buy Meta, but it gets to a point where you're picking up nickels in front of a steamroller, buying pullbacks to an uptrend line when you have big negative divergences building, overbought conditions. You can go out to the weekly chart and see it here. So it's only a matter of time, I believe, before Meta breaks that trend line. It could happen today, or it could happen 3 months from now. And when it does, then Meta breaks down, especially if the market breaks down. Meta will go visit the 200s. It hasn't checked its 200s in a long time. It's been one of the best performing of the Mag 7 or 8 or 10, whatever you want to call them. Tesla, just at resistance now. If you could make a stronger case to short the market, you could make a stronger case to short here. I can tell you it's at resistance. That's always objective to short with a stop somewhat above. So there it is. And again, so I don't have a strong opinion right now on Tesla at this point in time. I still like it longer term very much as a short trade, but like I said, I can see the potential here. I'm going to get to treasuries. Treasuries are going to rally sooner than later. They're going to have at least an oversold short covering rally, and we'll see what how the market reacts. It could really, if it's a pretty good rally in treasuries, meaning yields are dropping, you could have a pretty strong rally in the stock market. So all I'm trying to say is don't get married to any bias right now, long or short, or any heavy positioning on the equity markets. I'll get to the other trading ops in a second. Much better RR, clearer charts, if you will, and some of the other stuff. But I get the most questions come to me on the equity markets. Everyone likes to trade the stock market for whatever reason. I do too, but there's times where I press it hard with big positions, long or short, on the futures or the stocks that are highly correlated, the Mag 8, Mag 10, and there's times that I will just bounce around. I call it bouncing around the cues, off support and resistance levels, short-term trading like I'm doing now. Costco broke down. There's that primary uptrend line. I'm just trying to hit them all. Netflix, already broke down there. And and is heading towards that trend line there. And that's it for the top 10 right there. Let's move on. Let me cover Bitcoin, IBIT. Told you just the other day, was it earlier this week, that that if I'm correct on the bounce in the market, you're going to see risk on assets such as tech stocks and especially crypto. And the charts were constructive. You have positive, just like the stock market. No mere coincidence. This is far from mere coincidence. QQQ and SPY, everything put in a big divergent high there. We had a correction. We zigzagged down, and now we have 60-minute bullish, aka positive divergence, just like the stock market, because this has been mirroring. It's been a risk-on trade. So you're not diversified if you're trading QQQ and Bitcoin long at the same time or short at the same time. You just have one that's going to tend to go up and down more in percentage terms, which is Bitcoin, because it's higher beta, it's more volatile. And that's so far. There are times where I've seen it disconnect, and originally the big Bitcoin fans, whatever you call them, Bitcoin bugs, I don't know what the term would be. Their thing was it's a hedge against the stock market. If the stock market goes down, and it's an alternative way to put your money. Well, it's turned into just a gamble, a speculative, a lot like the meme stocks, and so. Again, what I'm getting at is that correlation is positive now. There are times where it disconnects, but it's mostly been an on-off, mostly on with correlating with the stock market. So just keep that in mind. So, and it's moved up the last couple of days, nice about 10% pop off that divergent low so far. Where to? Well, follow the stock market. If it's a back test, just like the stock market, well, there's where it's going. And that means we could go up another, easily another 8, 9, 10% right there to back test it. Let's see, what else do I have for you? That's Bitcoin. Let me just show you BRR, the Bitcoin futures, or the actual spot Bitcoin. I think I have it here. Yeah, BTC crypto right here. There it is. This is a 60-minute chart. You can look at it here. I also view it on a 5-month. Yeah, 5-month, 2-hour candles. Same thing. It's that divergent low. I'll borrow this one. Copy commentary. And I think I covered this with you the other day. We had this and that little false breakdown right there, just like the stock market. Expected that to be a whipsaw, positive divergence. I like to buy things with positive divergence on the 60-minute chart, which this is a 120. I just had it on a 60 to begin with. And so that's it. So, usually you get at least, especially in Bitcoin, minimum double-digit rallies, 20, 30%, sometimes a lot more. And then look, if tomorrow or 3 weeks from now, 3 months from now, we break that level after this bounce has run its course, that's going to be a powerful sell signal. You can see that is a well-defined shelf of support right there at about 9,300, roughly, somewhere around there. So as of now, we're just coming off a divergent low, and looks like we could have some more upside on Bitcoin. All right, let's talk treasuries. I know they're not doing anything, but that's part of being diversified. They're just sitting here. The rate of descent has really slowed down. It's been kind of flattish the last couple of days. This is TLT, the 30-year. We still have positive divergence here on the daily chart. Still, the PPO is still indicating a bearish trend. This is a trend indicator right here. Bullish one above, bearish one below. You can see by the boxes. But 60-minute chart still looks constructive, divergent low. IEF also even better. Remember, they're really going to follow the 10-year. This is, IEF is still in that orange zone. That's why the stock market's been sucking wind, can't catch a bid, and won't catch a bid unless we see treasuries rally. I feel pretty confident on that. And I also feel pretty confident of the charts. And this is a well-defined downtrend line. Remember, the most important bond to watch is the 10-year treasury. So watch IEF. We trade TLT for the juice, or ZB, the treasury, 30-year treasury bond futures. So watch for a breakout right here on the 10-year on IEF, and that will spark a rally. If so, as I've often stated, and I've been stating for I always stated over time, but there's two things that can cause a treasury bonds to rally, or bonds going up, yields going down. One would be a natural abatement. Let's just say this goes up and there's no stress in the stock market. nothing causing a flight to safety bid. That would be net bullish for stocks. In other words, bonds go up, means yields are falling, stocks are going to like that. However, this can also happen if the stock market craps out, if it turns around, breaks the recent lows, takes out the divergences, we start selling off pretty hard. Institutions will then often flock into treasury bonds despite the longer term outlook, but moving money is a flight to safety bid. So that's what you don't want to see. However, as I've mentioned, if you're long treasuries, you'll take it. Doesn't matter why they rally, whether it's a flight to safety bid or natural, abatement in inflationary forces and expectations of interest rates in the future. It doesn't matter what your reasons are. So I still like that, especially for any long-term core shorts on the equity market, because if you've been in that, you've lost a little bit, not much, but a little bit on treasuries in the last few weeks. But you've made plenty of money on the stock market on shorting QQQ or SPY. So that's what we'll watch. And if you trade futures, ZN is the 10-year Treasury note futures contract. Still big, big, just like IEF. Big divergences building. This is a 60-minute chart. And there's a nice clean downtrend line in which to pop. That's going to trigger very likely a pretty impulsive short covering rally. That's my minimum target there, 109.086, with a secondary and preferred target up there about 111, 189. Again, that would, if that happens, if it's not a flight to safety bid, that could spark a pretty powerful rally in the stock market and risk on assets like Bitcoin. So keep an eye on that. Breakout looks imminent, but imminent is relative to the time frame. This is a chart spanning 6 months. Imminent doesn't mean today, doesn't mean, by the close today. It just means in the coming days to weeks. Nat gas, still looking for my $5 price target, or sub 5, almost close to the $5 level. I've covered that many times on the longer term charts. We're not looking at that here. This is just an hourly chart of UNG, Nat gas ETN. Coming up, we effectively came close enough to count that T7 as being hit. Remember, we had the breakout recently above this trading range, and still looking for one last, well, maybe not be one last thrust up. We may zigzag up, but usually once you break out, like, let me show you the futures. Futures are just so much more clear when you're trading natural gas to me. Let me find it here. All right, this is NG 6-month chart, the one I've been covering for a while. Every now and then I have to roll it and replicate the lines and the levels, but there was our breakout above 352, breakout right there. I talked about it's huge, 25% daily gain that day. It's a little too much, too fast, corrected. And here's that uptrend line I gave you recently that so far they've been buying pullbacks too. And we did put in, this is almost about equal highs there on the PPO or RSI, some divergence on the 60-minute chart of nat gas futures and this 120-minute chart. But nat gas, when it hits that kind of rally mode, it can burn right through. If it is headed to my $5 target, then it's probably going to burn through these 60-minute divergences and 120-minute divergences here. At this point, we already broke out and then came back in to wash out. That, as I said, would be a very nice stop clearing move. Shake out a lot of weak-handed longs, suck in some short sellers thinking the breakout failed. And then, as I said, once you recovered back above that level, that's the bullish, buy signal, if you will. And sure enough, once we recovered that level, it's been I have to measure this way. I have to move the line here so I don't move the other lines, put it there. It's, ripped up another 23% from there. So that's it. We need to punch through that high. I think it's likely. Natural gas is clearly a bullish trend for the last few months. And so that's it. And USO, let me show you USO. Again, this chart I shared this morning. In response, somebody asked if I was still long crude. I said, yeah, unfortunately, took some licks on it, but sticking with it. Biden announced some new sanctions. I glanced at the headline on Russian oil a couple days ago that caused this spike that happened right after I shorted it. And I read that I think it's his way of trying to kick Trump in the nuts by spurring more inflation. Obviously, I'm sure he knew that would spike oil. and he probably wants to leave a mess for the incoming administration. It doesn't matter. Let's it is what it is. That's the fundamental catalyst for the news. But this was, remember, I created these zones back here when I did TLT back at the early last year, stating the same thing, that the stock market, same thing, yellow zone, it gets a little, gas prices are getting up there. Orange zone, the market will really start to take note of rising oil prices, which it certainly has. And then the red zone is where, again, it will likely freak out. So all I can tell you is back then, it was a level I created, all the way back in early 2024. It is still a very well-defined resistance level. USO, a lot of traders will use this as a proxy for crude. I'll trade CL, but I'll use this chart very much. And all I can tell you is this is the highs, the multi-year highs right there. Every time USO has gotten up here, it's been smacked down. So if it breaks out, that's going to be nothing but bearish for the stock market. Unless it's just a false breakout. Sometimes you get up here, everyone sees the levels, the powers that be want to punch it through there. If they can, they clear out, they suck in some new longs, blow out the shorts, and then reverse it. So I'd give it a little room if you're shorting crude, if you're willing to swing it. And then the chart I posted earlier today in one of the comment sections in a reply to someone, these are the two targets, on the daily chart, 79 and then 75.65. All right, so there's crude oil, and let's see what it looks like on the 60. Got some divergence there on the RSI, 15-minute I know on the futures, and on USO I have a divergence forming on the 15-minute chart, which could likely be the catalyst for a reversal there. Grains, let's wrap it up with the grains. I'll get the video out to you guys. Plenty of time before the close today. Wheat, there's the downtrend line right there. Wheat has outperformed the last couple of days, as I suspected it would. A couple of days ago, I told you, I said, I take a shotgun approach because they tend to move together. The three big grains are wheat, corn, and soybeans, but I've had an overweighting in wheat because of that underperformance. It's starkly and unusually underperformed corn, and those two tend to move almost in near perfect unison. And so what wheat's doing, it's been closing the gap. Again, it's the last few days, and either way, it's on this chart, this daily chart, it's broken out. It's not impulsive today. It was up earlier, gave back those gains. You had a couple intraday breakouts that failed to close above the line. You want to see it start to get away from this trend line. And that's, again, the primary downtrend line. Now, on the futures, which, let me say, and I often do, are much more important, because what we were just looking at, wheat, I cover that for the majority of you, those that don't trade futures. It's an ETN. You get to K9, not K9, the tax reporting form at the end of the year. I'm drawing a blank on it, but it's a little different thing. Some brokers won't even let you trade the ETNs, but the ETN wheat is tracking the futures, so you want to watch the futures. That's all that matters, and you see the breakout right there. Oops, I'm trying to circle it. I did down my circle tool. So there's your downtrend line. That's a 6-month chart, 2-hour candles, big positive divergence. And wheat needs to take out that 552.5 level. You can see all these potential price targets, resistance levels here. And then, of course, corn, soybeans already broke out. I highlighted that Friday. Made sure to get that out to you. There was powerful breakouts so far, follow through, which I like to see. So corn is clearly above. Remember, it first broke out above the downtrend line. Then it took out that basing pattern right there, the top of that 1882. So clearly on a buy signal unless that fails. Soybeans too, clear breakout above the downtrend line in the first two resistance levels. And then, as I've said, the ag input stocks, which are fertilizers and the likes, they have noted the breakout, as I have, and we've had some really nice gains in the last couple of days. You can see they're moving up impulsively, because traders like me that know that they tend to follow the grains will take them. And they broke out on their own merits too. That downtrend line was taken out there. This is NTR. If I didn't make mention, you can see in the middle of the screen the watermark, usually, unless it's buried. CF moving up nicely. A lot of these are trade ideas I threw out a few months back. Told you I would take some starter positions and add to them when the grains broke out, the charts firmed up. This one's yet to break out. A lot of potential in Mosaic. When I go to the long-term charts, I just want to say that this is a weekly chart here. Look at you can see the 200-day moving averages capping all the advances and that beautiful downtrend line. So if Mosaic pops that and you're just a trend trader on the weekly, I'd give you just these two targets right there, 33 and a quarter, 41.75. That's going to give you about a 20% run there and a 52% run to that second target. And the nice thing about most of these stocks here is you get paid to wait, meaning they pay dividends on a lot of them. Not all. You have to check each one. T3 has now been hit on ICL. Here's one, threw it out back here. I think I threw it out before it even broke out. Yeah, I must have, because T1 was right here. I wouldn't have put T1 right above the breakout level. So T1, T2 hit, T3 hit. It's above T3. That should open the door for a move up to T4, especially again if the grains crap out and those breakouts fail, then these guys may go back down again. But as of now, that hasn't happened. And so as I get down to some of these smaller ones, you have higher gain and loss potential. As I click this list, I'm going through an order of market cap, and you get down to those smaller ones, which I've covered recently. The two I like the best, and the small ones are, I like IPI a lot. AVD I like, nice bullish falling wedge, needs to pop $5 in that downtrend line, and then the profit potential is this 786 and downtrend line. That's about a 60% gainer if hit. And then seed, again, you're getting down to a lower price, small market cap stocks, but the gain potential is pretty big on a lot of these smaller ones here. So the way I do it, I take a shotgun approach. I sprinkle a little bit in each one. More money into the larger ones that I covered in the beginning of the video. They're more stable companies with larger market caps, more diverse business models, better management. And then the smaller ones like this one here, you're not going to put as much, nor do you need to, because if it pans out, you make a couple 100% on this one. 143% right there to this target. You can see a nice level right here. Secondary target right there. And if you wake up to a big gap down because of a delisting announcement or something, then you didn't have too much in there enough to get hurt. And so that's it. That's everything I wanted to cover on my list here. I'll do an update on GDX for you if you're in there. Remember, I revised this one recently to give you a first target throughout GDX before over the holidays right there to buy it here on this pullback to the support zone. Start scaling at the top down to, but not below the bottom of the zone. We reverse from there. Then the other day when we were at T1, I said, look, I'm going to add a level because I'd only given you a sold target up here. And I said, I'm going to add a first target there. We'll probably get a pullback. And we did. So if you took profits there, like I said, we'd probably pull back. Look where we went to, right back to S1 for support. So this is swing trading. You exit your long, or you turn around and short it, gain 4% pullback, or you sidestep a 4% loss. You recycle back in long, and now your next buy signal will come. That's an objective long, as would be a breakout or a buy signal and a break above the recent highs, and opening the door to a T2 there. What might make that happen too? The euro, US dollar, gold tends to move in correlation to the in sync with this one. It's just the euro against the dollar. You have a nice bullish falling wedge pattern. Dollar's been really strong. Euro's been getting beat up against the dollar. Big positive divergence there. And so if this breaks out, that is net bullish for both the stock market and for gold, because they tend to move, gold and the stock market tend to move in line with this chart. In other words, they go up and down with the euro, or another way to say that, they move inversely with the US dollar. Not always, but most of the time. So that would just be a net plus for gold if we can break out here in euro. And again, possibly the stock market could give us a rally that takes us up to back test those trend lines, possibly even take out the previous highs. So that is it. That's a lot of stuff to watch. Most of it's interrelated. But then again, the ag commodities have nothing to do with the stock market, and that's a great example of being diversified in an uncorrelated asset class that has nothing to do with the stock market. It marches to its own drumbeat. Even those ag input stocks I told you about there, most of those are not big or heavily indexed components. So it is possible to see the stock market going down and those guys still rallying. So that's why, focused there for obviously a pure play because they look good first and foremost, but also just a way to, again, further diversify among the current longs that I have on the equity market. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.